What's up, everybody? My name is Rashad. I am a full-time options trader, and I bring in multiple six figures per year from the stock market. And today I'm going to show you 5 different option strategies to bring in consistent and reliable income. For me, options has allowed me to buy my freedom back, and it has given me the ability to do what I want, when I want, with who I want, for how long I want. And I want the exact same thing for you, so let me show you a few strategies. The first strategy is selling puts. Now, there are 2 main reasons that anybody would sell a put. One is to either make money, aka generate income, or to buy a stock cheaper than what it's selling for today. Now, you may also hear selling puts referred to as short puts, naked puts, or cash secured puts. But let me show you an example of how selling puts would work. So for this example, we'll use Apple stock. So let's say Apple stock is currently trading for $175 and you want to sell a put. So you're over here, and then on the other side of every trade, there's going to be a buyer. So there's a put buyer. So Apple's trading for $175 and you go to the buyer like, hey, I will buy your shares of Apple from you if the stock price drops. However, for doing so, giving you this insurance, essentially, you have to pay me money right here, right now. So in this example, you could sell a put at $165. So remember, the current stock price is $175. So we're selling a put at $165 for an expiration of 30 days out. And for doing so, the buyer pays you $200 immediately. Now, here's what happens over the next 30 days. As long as Apple's stock price stays above that $165 strike price, you get to just keep your $200 and you go about your day. And usually in most scenarios, that's what happens. However, if the stock price drops below $165, which you can see over here, you will start to lose money. Or you just simply have to buy the shares of the company at that strike price. So that is why I said earlier, people use this strategy in order to buy shares at a cheaper price, because if you use this strategy on a company that you already like anyways, then not only do you get that company at a cheaper price, you also got paid to wait. Now, the second strategy would be to sell a covered call. And the objective for covered calls is to generate income on a stock that you already own. So let's take a look at an example of a covered call. So using the example of Apple again, we have Apple still here at $175. And let's say you purchased 100 shares at that $175 mark. Well, what you can do is you can immediately sell a covered call anywhere above your cost basis. So if you paid $175 for the stock, you could immediately sell a covered call, let's say in this case at $185. And for this example, we'll do 30 days from now and you'll receive $200 for doing so. So here's what happens with this. So if the stock price stays below 185, you will keep your shares. Then at the end of the 30 days, you could just sell another covered call. However, if the stock price is above the 185 after the 30 days, then you'll be forced to sell your shares at that stock price, which in most cases is great, because not only will you get the $200 you receive from the options contract, you'll also get those capital gains from the $175 that you purchased the stock at, all the way up to that $185. So just as an example, if you had just 100 shares of Apple and the stock price went up that $10, you'll receive that $1,000 from the appreciation of the stock, and then you also get that $200 from the options contract as well. Now, covered calls in general tend to be the most safest option strategy that you can possibly utilize. Now, when you combine the selling of puts and the selling of covered calls at different times, you get what's called the wheel strategy. So if we can see here, the first thing you would do in the wheel strategy is you would sell a put. And when you sell a put, as we've discussed, you immediately collect money. Well, in the instance that the stock price drops below your strike price for your put, you will get assigned the shares, which simply means you have to buy the shares. Well, when you buy the shares, you can then immediately sell a covered call. And when you sell that covered call, again, you will receive money as well. And then you'll simply wait for the stock price to rise above your covered call, and then you will be forced to sell those shares. And now you're back at step 1 where you can sell a put again. And that is called the wheel strategy. And the wheel strategy is a strategy that I definitely utilize very, very often. So selling puts, covered calls, and the wheel strategy are all 3 strategies that are pretty much very simple and very basic when it comes to the world of options. So now we'll get into strategies that are a little more difficult. However, they typically bring in more money as well. So our third option strategy is the short strangle. Now, the objective of the short strangle is to generate income and profit from the stock price staying within a specific price range. So let's take a look at an example of this. But first off, what are the key components of a strangle? First off, it is a 2-legged strategy. So you will sell a call option and a put option simultaneously on the same stock for the same expiration date. So your call option will be above the current market price and the put option will be below the current market price. And that is why it's called a strangle, because you want to keep it within that stock price range. So here's another example. So let's say we still have Apple stock and it's at $175. So what we can do is we could sell a put at $165 and then sell a call at $185. Now, with this strategy, I like to select strikes that have a delta of less than 0.05. If you're not familiar with delta, delta is simply the probability that the event occurs. So if the delta is 0.05, that is saying that there is a less than 5% chance that the stock price hits that strike price, either of those strike prices, within this given time. So when I do run this strategy, I usually select expirations within 7 days. And for this example, let's say we received $100 of premium. Okay, so if we go over here, we can see the profit and loss diagram. So as long as the stock price stays between that $165 put and that $185 call that we sold, we will make money. But now see, if the stock price were to dramatically drop or dramatically rise, then that is when we would start to lose money. All right. So when you are doing a short strangle, you really want the stock price to stay within those boundaries that you've set. Now, I made a ton of money in my earlier years selling strangles. I sold a ton of strangles on Tesla. And because Tesla stock has always been very, very volatile, the premiums were always really, really good. Now, the one downfall to this strategy is you do have to have a pretty large account in order to do it. And when I say a pretty large account, if you have an account of less than $100,000, this probably is not the best strategy for you, especially with a higher price stock such as Apple or Tesla. However, let me show you a strategy that you can use even if you have a really small account. Now, the fourth option strategy is called credit spreads. Now, the objective of credit spreads is to generate income from the stock price staying above or below your strike price. Now, you may also hear credit spreads referred to as vertical spreads. So the key components of a credit spread, it's a two-legged strategy. So it's the sell of one option and then the purchase of another option further from the money with the same expiration date but different strike prices. And your maximum profit will be the money that you received minus the premium that you paid out. Now, the first type of credit spread is called a bull put spread. So this is when you sell a put option with a strike price closer to the money and you buy a put option further from the money. So you would use this strategy when you either believe that the stock price is going to go up or it's going to remain roughly the same. So here's an example down here. So we have a stock price that is currently $90. What we could do is sell a put at 75 and then buy a put at 70. Now, for doing this, we receive premium of $100, and the maximum amount you can lose is the difference between your two strike prices, which in this case is $75.70 minus the premium you received. So in this case, our max loss would be $400. All right, because 70 and 75 are $5 of difference. You times that by 100 because contracts are always worth 100 shares. That'll get us to $500, but now we received 100. So we'll minus that, and now you're at $400 max loss. Now, typically with a credit spread, your brokerage will only require you to have as much money as you can possibly lose in a trade. So to put on this exact trade, you would only need $400 in your account. But as you can see over here from the profit and loss diagram, as long as the stock price stays above $75, you will be able to keep the entire $100 that you received. However, as the stock price drops, you will start to lose more money. But in the strategy, as you can see, the max loss is $400. So you can see it flattens out right there. So that is the bull put spread. But on the other side, we have the bear call spread. So with the bear call spread, you'll sell a call option with a strike price closer to the money, and you buy a call option further from the money. So in this case, we have a stock price that is currently $50. So what we can do is sell to open a $70 call and then buy to open a $75 call. In this scenario, it's the exact same. We received a premium of $100 and we have a max loss of $400. So as long as the stock price stays below $70, you will keep the $100 that you received in full. However, if the stock price rises above 70, you will start to lose money all the way up to a $400 max loss. So for selling a bear call spread, you either think the stock price is going down or that it's going to remain roughly the same. But altogether, credit spreads are an amazing strategy to utilize because one, you can determine and limit your max loss, and this strategy could be utilized by people from small to large accounts. But what happens when we combine both a bull put spread and a bear call spread? Well, that strategy is called an iron condor. And iron condors are probably one of the most popular option selling strategies that there is. And I actually utilize iron condors every single week. So the objective is to generate income from the stock price staying within a specific price range. The benefits of iron condors is the low cash requirement and limited risk, just like with both of the credit spreads. However, when you do both at the same time, you're essentially getting double the amount with iron condors than you could from doing just one credit spread. So the key components of an iron condor are essentially the two credit spreads combined. All right, so you have 4 different legs. You have a short put and call and a long put and call, which is basically the bull put spread with the bear call spread. And the same as before, the maximum amount that you can receive, and just like before, the maximum profit is the premium you received minus the premium that you paid out. So here is an example of an iron condor. So let's say that a stock price is currently at $70. What we can do is sell to open a $65 put, buy to open a $60 put, and sell to open a $75 call, and buy to open an $80 call. For doing so, our max gain would be $300 and our max loss would be $200. So if we look at the P&L diagram here, as long as the stock price stays between that $65 short put and that $75 short call, we get to keep all of the money that we received. However, if it goes below that $65 put or it goes above that $75 call, that is when we will start to lose money. Now, as a trader, when you're using iron condors, you want to make sure to pick a good stock to trade it. You want a stock with a little bit of volatility so that it does have good premiums. However, you don't want a super volatile stock like a meme stock because you do need it to stay within that specific price range. So when I'm utilizing this strategy, I usually select expirations within 7 days and I keep my deltas below 0.05. And I'll typically trade it with a mega cap stock such as Nvidia or Tesla. But if you like this information and you would like to learn more, feel free to join me in my community called Trade to Freedom. Within this community, you get my actual trades in real time. So as I'm making money, you could possibly make money as well. And then not only that, if you are new to options, there is a full options course in the program. So come trade to freedom with me, buy your own time back, and obtain the ability to do what you want, when you want, with who you want, for how long you want. I hope to see you there, and I'll see you in the next video. Peace.